Welcome, adventurers, to the journey of a lifetime, the quest for financial freedom. In a world where the waves of market volatility crash against the sands of time, there exists a compass, an ancient navigator that has guided countless voyagers through the tumultuous seas of investing. This tool, known to the wise as the Rule of 110, is our map to treasure beyond measure. But beware, for not all who sail the seas of wealth have the knowledge to avoid the sirens of risk and the whirlpools of uncertainty. Did you know that, historically, about 90% of the world's millionaires have been created by investing in the stock market, yet so many are lost at sea, without a chart to guide them? The Rule of 110 is not just a number, it's a beacon, illuminating the path to prosperity by balancing the sails of risk and reward according to the changing winds of our lives. In this epic tale, we're not just skimming the surface. We'll dive into the depths, exploring how to customize this ancient wisdom for the modern world, understanding the psychology that anchors it, and learning from the voyages of those who've navigated these waters before us. We'll compare our compass with other maps, adjust our course as the tides of life shift, and master the art of risk management to safeguard our treasure. And for those ready to embark on this voyage, fear not the changing tides. We'll equip you with the knowledge to start implementing the Rule of 110 today, ensuring your journey is not a leap into the unknown, but a step towards a future-proofed haven of financial security. So grab your compass, set your sails, and let us embark on this journey together. The Rule of 110 awaits, a guiding star in the night, promising the riches of financial freedom for those brave enough to navigate its truths. Join us and discover how to master the stock market, not with a heart full of fear, but with a strategy that has stood the test of time. Chapter 1: Introduction to the Rule of 110. Explaining the basics. Imagine you've just discovered a treasure map. This map doesn't lead to gold buried under an X. Instead, it guides you through the complex world of investing, making it simpler, clearer. That's what the Rule of 110 is like for investors. It's a straightforward formula. Subtract your age from 110 to find the ideal percentage of your portfolio that should be invested in stocks. The younger you are, the more risks you can take, aiming for higher returns. Conversely, as you age, this rule suggests shifting towards more stable investments like bonds. The beauty of the Rule of 110 lies in its simplicity. It's accessible to beginners yet robust enough for seasoned investors to appreciate. For example, if you're 30 years old, the rule suggests 80%, 110-30 of your investments should be in stocks. This mix aims to balance growth with risk over time, adjusting as you near retirement. It's like financial wisdom passed down through generations, distilled into a simple number. Historically, stocks have outperformed other investment types over the long term, despite their volatility. The Rule of 110 taps into this growth potential while gradually reducing exposure as your risk tolerance decreases with age. It's a method that doesn't just guess at the future, it plans for it, making adjustments as your life and the markets change. Chapter 2: Historical Success of the Rule of 110. Proof in numbers. Diving into the past, the Rule of 110 isn't just theory, it's proven by history. Over the decades, stock markets have experienced ups and downs, but the overall trajectory has been upwards. By investing a significant portion of your portfolio in stocks early on, you harness the power of compound interest, turning small investments today into substantial sums over time. Let's talk numbers. Historically, the stock market has returned about 7% annually after adjusting for inflation. This might not sound like much, but over 30 or 40 years, it's the difference between retiring comfortably and worrying about your financial future. For instance, a $10,000 investment in a broad stock market index fund at age 25 could grow to over $149,000 by the time you're 65, assuming a 7% annual return. The Rule of 110 has adapted over time. It used to be the Rule of 100. As life expectancies increased and retirement years extended, the number was adjusted to account for the need for more significant growth over longer periods. This adaptation underscores the rule's flexibility and its foundation in real-world trends, not just theoretical assumptions. Critics of the rule argue that it oversimplifies complex investment decisions or fails to account for individual risk tolerances. However, its historical success lies not in pinpoint accuracy, but in providing a solid, adaptable framework for investors. It's about setting a course that can be adjusted rather than wandering aimlessly in the vast sea of investment options. Through recessions, booms, and everything in between, the Rule of 110 offers a beacon to navigate the stock market's choppy waters. It proves that sometimes simplicity, grounded in historical success, is the ultimate sophistication in investing. Chapter 3. Customizing the rule for your financial goals. Personalization tips. The Rule of 110, while powerful, isn't one size fits all. It's a starting point, a foundation upon which to build a strategy that mirrors your personal financial landscape. Imagine this rule as a suit. It might fit well off the rack, but with a few adjustments, it can be tailored to perfection. Here's how you can customize the Rule of 110 to better suit your financial goals and risk tolerance. First, consider your financial goals. Are you aiming for early retirement? Or perhaps you're saving for a dream home? Your goals dictate your strategy. If you're aiming for early retirement, you might lean towards a more aggressive investment approach, pushing beyond the standard allocations suggested by the Rule of 110. Conversely, if stability is your priority, you might tilt the balance towards bonds earlier than the rule suggests. Second, evaluate your risk tolerance. Not everyone can watch their portfolio dip by 20% without losing sleep. If you're risk-averse, you might adjust the rule to 110 minus your age minus 10, adding a cushion to your investments. This personalization ensures that your investment strategy aligns with your comfort level, not just your age. Lastly, consider your financial situation. Do you have a pension waiting for you, or are you solely responsible for your retirement savings? If you have a solid safety net, you might afford to be more aggressive in your stock allocations. Your financial situation is unique, and your investment strategy should reflect that. Chapter 4. The psychology behind the Rule of 110. Why it works. The Rule of 110 isn't just about numbers, it's deeply rooted in investor psychology. Understanding why it works can help you stick to your investment plan, even when the market gets rocky. At its core, the rule is a behavioral finance tool designed to simplify complex decisions and mitigate emotional reactions to market fluctuations. First, the rule encourages long-term thinking. By tying your stock market investments to your age, it subtly reminds you that investing is a marathon, not a sprint. This perspective is crucial during market downturns when the instinct might be to sell. Remember, the Rule of 110 is designed to weather storms, encouraging investors to stay the course. Second, the rule simplifies decision-making. The world of investing is vast and complex, with endless options that can overwhelm even experienced investors. By providing a clear, straightforward guideline, the Rule of 110 cuts through the noise. This simplicity reduces analysis paralysis, making it easier for investors to take action. Lastly, the rule adapts to change. Just as a ship adjusts its sails to navigate through changing winds, the Rule of 110 allows for adjustments as you age. This adaptability is comforting. It provides a plan that grows and changes with you, aligning your investments with your evolving life stages and risk tolerance. Understanding the psychology behind the Rule of 110 can empower you to invest with confidence and clarity. It's not just about following a formula. It's about adopting a mindset that promotes disciplined, long-term investment behavior. Chapter 5. Comparing the Rule of 110 with other investment strategies. While the Rule of 110 offers a straightforward approach to balancing risk and growth, it's one of many strategies investors might consider. Comparing it with other methodologies highlights its strengths and potential limitations, helping you make informed decisions tailored to your unique financial situation. One popular alternative is the bucket strategy, which involves dividing your investments into buckets based on when you'll need the money. This can provide more immediate liquidity and reduce the risk of having to sell stocks during a downturn for living expenses. However, it requires more active management and a deeper understanding of your financial needs over time. Another approach is the total return strategy, focusing on achieving the highest overall return without specific allocations to stocks or bonds. This method offers flexibility and the potential for higher returns, but requires a more active involvement in managing investments and a higher tolerance for risk. The dividend investing strategy is yet another path, emphasizing stocks that pay high dividends. This can provide a steady income stream, which is appealing to some investors, particularly those closer to retirement. However, it may also expose investors to specific sector risks, as high-dividend stocks are often concentrated in particular industries. Each of these strategies has its merits and challenges, and the best approach depends on your individual goals, risk tolerance, and investment horizon. The rule of 110 stands out for its simplicity and adaptability, making it a valuable starting point for investors looking to balance growth and risk over the long term. Chapter 6: Adjusting the Rule of 110 as you age, a dynamic approach as you journey through life. Your financial landscape shifts. Recognizing and adapting to these changes is crucial for maintaining a balanced investment portfolio. The Rule of 110 isn't static. It evolves with you, providing a guideline that should be revisited and adjusted over time. Imagine your investment strategy as a sailboat, navigating through the changing winds and tides of your financial life. In your younger years, with the wind at your back and a long journey ahead, you can afford to sail with more risk, capturing the full power of the stock market's potential. However, as you approach the shore, your retirement, it's wise to adjust your sails, shifting towards safer waters by increasing your bond allocation. This doesn't mean docking your boat and stopping altogether, but rather ensuring a smoother, steadier ride as you come closer to your destination. It's also important to consider life events that may necessitate adjustments to your investment strategy. Marriage, buying a home, or the birth of a child can all impact your financial goals and risk tolerance. Similarly, unexpected challenges such as job loss or health issues might prompt a more conservative approach. Regularly reviewing your investment portfolio in the context of the Rule of 110 ensures that your strategy remains aligned with your current life situation and future goals. Chapter 7: The Role of Risk Management in the Rule of 110. Investing by nature involves risk. The Rule of 110 provides a framework for balancing risk and growth, but effective risk management is about more than just adjusting your stocks and bonds allocation. It involves diversification, understanding market cycles, and not letting emotions drive your investment decisions. Diversification is a key principle of risk management. It's the idea of not putting all your eggs in one basket. By spreading your investments across different asset classes, industries, and geographical locations, you can reduce the impact of a poor performance in any single area on your overall portfolio. Think of it as a safety net that catches you if one of your investments falls. Understanding market cycles and the economic factors that influence them can also help you make informed decisions about when to adjust your investment strategy. While it's impossible to predict market movements with certainty, having a basic understanding of economic indicators can provide clues about the market's general direction. Finally, managing emotions is perhaps one of the most challenging aspects of investing. It's easy to get caught up in the euphoria of a booming market or the panic of a downturn. However, successful investors learn to stay the course, making decisions based on strategy rather than emotion. The Rule of 110 encourages this disciplined approach, providing a rational basis for investment decisions that can help keep emotional reactions in check. Incorporating these risk management principles into your investment strategy can enhance the effectiveness of the Rule of 110, helping to safeguard your financial future while striving for growth. Chapter 8: How to Start Implementing the Rule of 110. Today, embarking on your investment journey with the Rule of 110 doesn't require waiting for the perfect moment. You can start today. The first step is understanding where you currently stand. Take stock of your existing investments, if any, and assess how they align with the Rule of 110 based on your age. This initial evaluation will serve as your baseline. Next, consider your financial goals and timeline. What are you investing for? Retirement, a dream home, your child's education? Your goals will shape your approach, influencing how aggressively you should invest within the framework of the Rule of 110. Remember, the rule offers a guideline, but your specific objectives and risk tolerance will dictate the final allocation. Creating a diversified portfolio is your next step. Diversification isn't just about mixing stocks and bonds. It's about spreading your investments across various sectors, industries, and even countries. This strategy minimizes risk and positions you to capture growth from multiple sources. If you're unsure about how to diversify effectively, consider consulting a financial advisor or investing in broadly diversified index funds. Finally, commit to regular reviews and adjustments. Your financial situation, goals, and the economic landscape will evolve. Annually revisiting your portfolio ensures that your investment strategy remains aligned with the Rule of 110 and your personal financial journey. This discipline is crucial for adapting to change and staying on track toward achieving your financial goals.